Good morning, ladies and gentlemen, and welcome to the RBG Holdings PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question and then press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. We will notify you by email when that is ready for you to review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit to the following poll. And I'd now like to hand over to Nicola Thorsten, CEO, and Robert Parker, CFO of RBG Holdings. Good morning.
Good morning. Thanks very much. Good morning, everyone, and welcome to our presentation on our trading update for the year ended 31st December 2020. I'm just to introduce a little bit about myself for those of you that haven't met me or met me virtually before. I took over the commercial management of Rosenblatt in 2016 when the firm was still a private partnership, and I was brought in to look at the opportunities of restructuring the business for a public listing, which we achieved in 2018, with the sole intention, as I'll take you through later in this presentation, of exploiting the opportunities presented primarily from litigation funding, which has been around for about a decade at that point. My background is that I bought and managed and eventually floated and sold Brands Hatch Leisure Group of race circuits back in the 90s and early 2000s, selling it into public group at a return of 6 or 7 times money. I'm joined today by Robert, who has been my Chief Financial Officer since he joined in the summer of 2018. And as you can see from the presentation, he has done many businesses, but his first professional services business as it is mine. And I think that gives us both quite a unique perspective about how you can professionalize, or rather probably commercialize is the better word, commercialize these businesses, more of which I'll talk about later. So since the IPO, we have expanded from RBL, that was our initial only subsidiary, to acquire Convex Capital in 2019 and to start our own litigation finance business in 2020. We have very recently just made a small acquisition, sub £100,000, of an IT support services business, which will ensure that all of our IT support is effectively self-funding by the supply of IT support services to third parties. Again, in the same way, when I come to talk about law firms, that they haven't been hugely commercially run until the last few years with the rise, as you've seen, of other listed law firms. Similarly, their management of their technology, their grasp of what IT systems can offer them has not always been up with the industry. And obviously, you'll see from Robert's background, particularly having worked in tech, we're very keen to avail ourselves of all of the skills and tools that we need to commercialize the business and improve our margins at every turn. Moving on to the trading update. The performance in 2020, I think, demonstrated the group's resilience, and why this is largely down to the work that we did post IPO in structuring particularly the law firm. And law firms have a strong overhead, a big overhead that is difficult to flex. You have office rent and you have people, and we have worked hard to create an hourglass for our business. That means that we're quite heavily reliant on contractors, and one of the things you'll see later on is that our use of contractors has grown exponentially in the last 2 years. And obviously, if the work had not been there, we would have been able to flex. However, the work was there, and the law firm saw its best ever year. And we were surprised, I have to say, because obviously it was assumed that transactions would drop and that there would be a drop-off of work. But the opposite happened. And I think that the reason for that is largely down to the profile of our client base. Unlike a very large law firm that has a huge volume of clients and transactions, which are very low level in terms of their average fee of around, say, £4,000 or £5,000, which is what DWF's average fee is. We have a smaller number of clients and a smaller number of transactions, but they are a much higher fee level. And I think that protected us because those entrepreneurs and high net worths were very proactive during the lockdown because they were essentially stuck at home. And that continues to this day. Obviously, Convex was affected, as we announced last year. Deals were delayed and some cancelled. Mike Driver's done an incredible job of rebuilding his pipeline, which we'll come on to talk about. And obviously, we're expecting to see that change during 21. We have already announced the closure of one transaction in January already this year. The balance sheet remains strong, and we closed the year with a net cash of 3.5 million against net debt. Either it was net debt, Robert, and correct me if I've said that wrong, of 1.9 million in 2019. We have confirmed a 3p dividend on 2020's year end, which at the moment is likely to be a full dividend. And we will come on to talk about the dividend again in our full results when we report in April. Moving on to our strategy. I always at this point in any presentation remind everyone what our strategy was, so that we are always tracking how we are performing against our strategy, which keeps us honest and true and make sure that we are doing what we said we were going to do. So on coming to market, we said that we would grow the legal business, focusing on high margins, improving the commercial aspect of how the business is run, and align remuneration with shareholder interests and use equity participation to retain talent. This we think we have done. It is obviously in professional services quite a balance between private equity and private and public equity. And this we manage and monitor all the time. We've used our expertise to move into litigation finance. Initially in 2018 and early 19, we did it through RBL only, so taking on our own damages-based agreements, investing in our own client litigation, where we were the lawyers on the record. Then in early 20, we moved into third-party litigation funding, where Lionfish only funds third-party litigation through other law firms or to clients directly. We then said we wanted to have selective M&A to build and diversify the business away from obviously the group's reliance at that time on legal revenues, to create a broader professional services group, hence the acquisition of Convex. And if we look at the next slide in terms of how we've performed against that strategy, we have not only had a record year in RBL, but we also brought in a new MD who's being appointed. He came in as interim COO last year, with a view to focusing that business on maintaining the commercial work that we'd achieved, but also growing it through business development. Lawyers are not always the best people to do their own business development. They are very client focused in terms of the product, which is a really good thing. So it means often that the product that they do for the client is excellent, but they do not look at it as a commercial relationship. So having, again, a MD join us who is more commercial, he's not a lawyer by background, has a more commercial background, is enabling that business to continue to be very focused on why it's in existence, which is to make money. So as I said, the group has already moved into two types of litigation investments, RBL in 2018-19, and then that continues through expansion into Lionfish Litigation Finance. We appointed a very experienced managing director. It's important to remember when you look at litigation finance, and there's a slide later on where we talk a little bit about the industry, that there are two types of litigation funder, and they grew out of the two different expertises that existed. Either you were a really good litigation lawyer and understood litigation, and you went into litigation finance, but you had no finance background, or you were a successful hedge fund manager and you decided to come into this asset class with a little understanding of commercial litigation. There are very few people who have been able to grasp both sides of that business. Chris Bogart at Burford is obviously one of them, very successfully, both an ex-litigation lawyer and also been in banking. And I believe our managing director, Tetsu Shikawa, has also done the same. His background was in Goldman Sachs and Morgan Stanley. and he has been in litigation finance since it became available 10 years ago, and is probably one of the longest serving fund managers in this sector. So he has a very deep understanding of how it works. We undertook 7 investments last year against a backdrop of 240 applications for funding. So a high attrition rate of investments that didn't make the grade. So we are spend a lot of time looking at making sure we pick the right investments. And again, I'll talk a bit about that when we look more closely at Lionfish. We continue to have a conservative accounting policy. This gets a fair deal of press coverage, so I want to touch on this, that it is necessary for all publicly listed litigation funders to account to fair value, which means they have to do a fair value assessment of their investment, and we do that as close to cash as possible, so that our results do not have large unrealized gains in our revenue. So our revenue is largely cash, and our profits are majority cash. Moving to the acquisition of Convex, and why did we do that in 2019? There's much talk of whether this was the right investment for us. We were very keen, knowing that we were moving more and more into litigation finance, to make our first acquisition high cash generation. Convex traditionally has a 60% net margin, 80% gross margin. So it's a very cash generative business. And it should remember, although it had a tough year in 2020, which was largely due to the fact that people were not yet used to meeting by Zoom, not yet used to meeting electronically. So that made people pull back. We've now got past that, and we're all now used to doing this electronically and meeting people over different forms of electronic medium. And we have seen now investments take place against the backdrop of only having met over electronic media. So it's important to remember that they did in their past do about 8 deals a year, and did have a very strong reputation. For those that, again, of you that don't know Convex very well, it is a sell-side corporate finance boutique. It doesn't do advisory. It doesn't live on fees. It lives on success, which is why it was so badly hit last year. However, it therefore makes its business, and all of its people are used to making their pipeline, not waiting for it to knock on their door and come to them. So that makes them very entrepreneurial and very proactive and proactively driven. Mike and his team obviously missed their earn-out target in 2020, the timing of which couldn't be worse. So the total consideration is now 15.8 million for that investment, and there will be a write back in the 2020 accounts for the provision made on acquisition. I was keen to see that the team were motivated to continue to build the business, and we worked with them to find a mechanism that would be both motivating and economically viable. And so we came up with the replacement of the majority of the remuneration to the equity partners only, those that were the sellers in the business. So it only affects the directors or partners of Convex, and there's been no change to the remuneration structures beneath them for the staff. It's a highly commission-driven business. Anyway, most of the staff are incentivized on delivering success. And now the management team are largely remunerated through that success. And you'll have seen from this morning's announcement that they acquired shares in the market yesterday as a result of the first commission structure deal that took place in January. Moving to a bit about Rosenblatt, or RBL, as we refer to it colloquially. We continue to deliver the growth I've mentioned earlier through focusing on best-in-class resource allocation, making sure that we're using our resources in the best possible way. Obviously, a lot of people were stuck at their desk last year. It's easy to say that these numbers are driven by the fact that we had lockdown. You couldn't get out. There was nothing else to do. But it has to be remembered, the work needs to be there. There needs to be the deal flow. There needs to be the workflow. Growth areas we've identified. We've expanded our employment department coming into 21. We brought on a new competition law team who are very busy looking at the impact of Brexit and what that is going to do to businesses, and obviously insolvency and restructuring, which we anticipate will come back online. As you've seen from other announcements in the market, insolvency is actually down at the moment through the support that's available from the government, and that will of course unwind. Turning to our own investments, and this is a slide we used to have a couple of years ago, and I've reintroduced it so that there could be an understanding of what the potential is for this business. These investments were made back in Neptune is very old. It was in 2016. Sorry, somebody's moving my slides around. If I could have control back, that would be nice. So Neptune was an investment that we carried over from the firm when we took it public in 2018. We won that case last year, but it's been appealed by both sides, ourselves for quantum and by the other side for the delay in arriving at the judgment. Counsel's opinion is that there is an 85% likelihood of a win on appeal, and the appeal will take place in March 2021, apologies, so this March. And we were on CFA here, which means that we can only double our WIP. We had no cash investment on this case. So our expected potential recovery is 4.2 million. These numbers are never reported in our market forecast because they are unknown, and they are unknown as to when they will fall. As you can see from Neptune, we've been reporting that this is potentially going to happen since 2018. So it only goes to show how long some cases can take. Project Shango, we took on board in early 2019. It's a class action of a large number of individuals against a multinational brand name defendant. It is being vigorously contested by that defendant, and the case is likely to roll on into 2022. For those of you that saw this slide previously and are familiar with these numbers, they have changed as we develop the relationship with the client and we find more claimants. And as the claimant group grows, then that changes the potential recoveries and obviously the investment that we need to make in bringing this case. The next trial on this case is a preliminary trial on expert witness and expert evidence, will be heard in Q1 2022. So this is a long-running case. Mercury also we signed off at the end of 2018, and this is an individual's action against a branded media telecoms business in a different jurisdiction, but the case is being heard in an arbitration in Geneva. As a result of that arbitration being in Europe, it has been heavily impacted by COVID and hugely delayed simply because of the arbitration's inability to meet. And that is something that we have now resolved, and we understand the arbitration will meet in Q1 2021. So I just want to stress as I leave this slide that these numbers are not in our market forecast, and they are just to give a flavour of the potential of the sort of returns that we could receive over the coming years. And the anticipated returns are calculated. For those who are struggling to make that percentage work, the anticipated WIP is at retail on this slide, whereas actually the cost of that WIP to us is at 40%. So if you take 40% of that number, add it to the cash, and then divide it into the return, those percentages will then work. Moving on to Lionfish, and Lionfish is obviously our third-party litigation funder. Some of you may wonder at the branding. It's the play on words of L&F. It's a poisonous fish, it kills. So again, just a little bit of fun around the fact that litigation tends to be aggressive. The most important thing about this business for us is that it was important to make it profitable. An awful lot of litigation funders are profitable on paper. They obviously have to fair value account in the same way that I've mentioned earlier. And that means that they often have to show unrealized revenues, which means you've got unrealized profits and they are not cash profitable. What I've done in this slide, which is a little bit busy, for which I apologize, the left-hand box just gives you a comparison of what the listed funders are doing versus ourselves. It doesn't talk about results, it just talks about what their portfolios like, where their deals are coming from, and where they're getting what they're deploying and how many cases they're on average doing. So it's just an informational slide. The right-hand slide gives you a little bit of information about the private litigation funders, which are largely running like hedge funds. And you can see from the bottom yellow boxes that they are not massively profitable. And obviously, it's really important to remember why you go out to work. And we go out to work to make money. So we will be, in our first year, more profitable than any of those funders on the right. So that really was there as an information about how the industry works. And then a little bit here about how the litigation market itself has changed and where the opportunity lies. In 2011, when litigation funding really first hit the UK, there was very little capital available for it because it was an unknown asset class. And there was some ultra high value deals and very few funders were chasing it. And the numbers you could command in return were very high. And hence, if those of you who are familiar with Burford will have heard many times of 4 times rising to 10 times money returns. Because they had a monopoly, there was very little competition. Now there is a huge amount of competition. There is an enormous amount of money pouring into this asset class, chasing high value deals, looking for those same returns because that's what they've heard happens. The reality is that litigation funding has become cheaper because there is a lot more supply, but the number of high value, particularly litigation cases, has not increased. And whenever there's more supply and less demand, then obviously prices come down. We have looked at this, and Tets and myself feel quite strongly that the model that's been employed traditionally and still is by our competitors, it focuses on getting a big result at settlement or trial because we're on a normally percentage of the award, and therefore that focuses everybody on the far end of the case. For those of you familiar with litigation will know that the graph starts high, goes low, and then goes back to being high in terms of risk. So as you start a case, it's high risk. And as you negotiate with the other side and you go through disclosure and expert witnesses and evidence, then you start to see the colour of each other's eyes. You start to see what the litigation is all about. Does it have legs? Is it likely to win at trial? Is it likely to lose? And at that point, the parties get closer to settlement or the case falling away. And that's the lowest part of the risk profile of any litigation finance. And therefore, our pricing structures, which are usually based on a multiple of the money you have deployed or taken from us, and obviously the longer you have that money and the more you deploy, the more expensive it becomes. And therefore, in the first sort of year to 2 years, because the sweet spot for settlement is usually between 20 and 22 months post issuing the claim, then at that point, it's still been relatively inexpensive compared to traditional funders to take investment from Lionfish. And therefore, we're very much focusing our clients on taking that settlement and returning to us our money at a lower rate. But of course, we're able to recycle that money again. So I would say with Lionfish, of the 7 investments that we made last year, we will at least see 1 come to fruition in 2021. Which again will show the nature of the profile of our investments. Our sweet spot is 3 million to 50 million claim size, and anywhere between sort of a couple of 100,000 of investment up to 4 or 5 million per claim. So very different to Rosenblatt. It doesn't tend to take on the elephantine matters. So we did here on this slide again want to show what the potential returns were, not in our numbers. So we just here played with some numbers for your benefit to see if we had 10 or 11 cases underwritten a year, with an average commitment size of 400,000 per case, based on our pricing structure that we've just explained. If that's returned to us within 2 years, it would be a 200% return on money, so doubling the money 2 times. Generally, the pricing is money back within 24 months is 2 times money. Money back in 3 years is 3 times money, and in year 4 onwards is 4 times money. And that's a sort of general rule of thumb for our pricing, but that's very, very high level, not detailed at all. Obviously, this is based on a high success rate that we've enjoyed today. So turning to the outlook for the business, the group is in a strong position, I believe, with a strong balance sheet. We're well funded. We have good support, good client base. It was a record year for the law firm. We have successfully launched Lionfish as a fresh new generation funder that has delivered to our expectations in 2020, and Convex Capital has seen its pipeline being rebuilt, and thanks to the pressure brought about by Rishi Sunak having announced that he's likely to change the capital gains tax regime, this is putting quite a lot of pressure on businesses who are thinking of selling at some point to do so in the short term, and that's driving a lot of the activity that Convex is seeing. So I am confident of our outlook for 2021, and thank you very much for joining us today.
Nicola, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, will be accessible via your Investor Meet company dashboard. I'd also like to remind you that feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can understand your views and expectations, and we'd be very grateful if you could allocate a little bit of time for that. Nicola, before I guess we look at the questions that have come in during this presentation, investors had the ability to pre-submit questions, and thank you to those investors that did. The first question, there's three here that I'd like to ask you. Congratulations for an excellent performance in difficult circumstances. I'd be interested to understand what factors have driven demand for Rosenblatt's legal services.
I think largely, as I said in the presentation, we have a unique, fairly unique client base. It's largely entrepreneurial high net worths who tend to be proactive in times of economic difficulty and opportunity, which obviously the pandemic provided. We've benefited from both contentious work, which was inevitable, I think, in a crisis, but also transactions. And last year saw some which are as a result of the pandemic, but most were not. So particularly some may have seen that we acted for Simon Cowell and his buyout of Sony from Psycho Entertainment. So Psycho Entertainment, although it was his company, was partially owned by Sony. And he came into dispute originally with Sony. And that was a dispute that we ran the year before, and it culminated in a buyout of that business in the last year.
Thank you very much indeed. The next question that we have is, clearly COVID-19 has presented challenges. Has this meant that Islero's launch has been delayed?
So no, but as with Manolete, we've not seen as many insolvency assignments. It's also important to understand there is a difference between Islero and Manolete in how they fund litigation and Lionfish's main model. So they tend to buy insolvency claims off insolvency practitioners and run them in their own name. As a result, they do tend to be lower commercial value, and we haven't seen as many of them in the same way that Manolete have not. However, the higher value commercial litigation, some of which is around insolvency, we have continued to see as Lionfish, and on much bigger claim sizes and much bigger investment requirement. Indeed, we did one of them of our 7. One of them is an insolvency litigation.
That's very kind, thank you. The final question that we have here from that was pre-submitted: has Lionfish experienced the dramatic fall off in new cases seen by Manolete, or has Lionfish picked up some of the business that would have historically gone to Manolete?
No, the business is not there. So we have seen a fall off in IP assignments, as I mentioned, but because we are, again, and our focus always is to be a broader business, Lionfish funds all types of commercial litigation, and therefore has seen an increase in case flow, not a decrease.
Thank you very much indeed. So that addresses those questions that were pre-submitted. So thank you to those investors that did so. Perhaps Nicola and Robert, I could ask you just to click on the Q&A tab. Obviously, the questions are in time order. If I could ask you to read out the question, because of course no investor can see another investor's question, and perhaps if you could give a response where it's appropriate, and then I'll pick up from you at the end.
Okay. I will just ask Robert to answer Mark's question, which is, given you have a lot of in-house expertise valuing businesses, what is your own valuation estimate of RBG, and what is your preferred valuation methodology? Easy question to start with, Robert.
How can I answer this? I think the simplest valuation mechanism was often the best. So a multiple on EBITDA or earnings. And then the other part, I suppose, which is missed in our valuation, which is difficult to value, is the potential upsides from the litigation investments as well. So because we're a bit of a hybrid, I don't think it's very easy to value us as a business. I will obviously say I think we're significantly undervalued. But as part of that, I think potentially what is missing is that getting full appreciation for the potential upside of the litigation assets that we're investing in as we build this business, and also getting proper recognition for what is, RBL is a core part to our business, and I think it has, market leading metrics within it around our utilization, realization, our profitability, and perhaps because we are smaller in comparison to the other people in the market, that we don't get full appreciation for the profitability that drives. So in a roundabout way, I think there's a simple mechanism. I do think we're undervalued, but also I think part of what we're doing today is to deliver greater understanding of what value is in the business.
Thanks, Robert. The next question is, can we talk about the deal with Mr. Rosenblatt and why that was needed? And I think a couple of other people have asked a similar question. I think that we have to remember that because Mr. Ian Rosenblatt is a large shareholder, and a lot of his remuneration arrangements and arrangements are subject to disclosure, but that doesn't necessarily mean that they're unusual. And Ian had restrictive covenants and had restrictive covenants with his employment contracts, and these were restructured and changed to extend them. And it was a one-off arrangement in that we took them to the longer term. I think at the time of the IPO, there had been a view that that would not be needed for the duration of time, and that view changed. Restrictive covenants in employment are extremely difficult to enforce under law, and they are much easier to enforce when consideration is passed. And that is why we did them the way that we did them. The expectation for dividends for 21 remains that we are looking to always do up to 60% of distributable reserves by way of dividend, and that hasn't changed. Our future thoughts on M&A, and I will start the answer to this question and leave Robert to add his own, but we remain very focused on what the opportunities are that are out there. There have been many deals done in our sector. Some of them are not done particularly commercially in a way that we think makes sense, and that does tend to skew the way our market looks at deals and what values should be paid for particularly legal service businesses. So we continue to look for the right opportunities, and more importantly for us, the right opportunity is a fit with our own culture. So many people have a view, quite correctly, that professional services businesses are really difficult to build and grow because they're people businesses, and people are obviously very unexpected and difficult to predict. But actually, entrepreneurs are very easy to predict in the way they operate. And I have a particular desire, being an entrepreneur myself, to build a group of very unique, high margin, specialist, commercially hugely focused entrepreneurial businesses that are run by entrepreneurs. Ian Rosenblatt is an entrepreneur. Mike Driver is an entrepreneur. Tetsu Ishikawa is an entrepreneur. And we want to build a kind of house, if you like, that will accommodate those entrepreneurs and give them the space to do what they do best. And if we can deliver that, then we will have a very more successful professional services business than we do today. Robert, do you want to add anything to that?
Yeah, I just want to add that we won't be a very active M&A business. It will be very selective, and as Nikki has said, that it'll be driven on some core metrics, that we're buying them at the right price in order to deliver value, which is not hard. It's not easy in this market because some of the prices are ridiculous, and some of the value that people places on their business. So it's just to say that we won't be doing what Knights does, which is very active M&A. Ours will be very selective.
Mm-hmm. So moving on to a couple of other questions. Roger asked, did the Convex partners buy the shares, or were they given them by RBG? No, they bought the shares in the market yesterday. So as they earn commission under the commission scheme, which is 20% of any fees delivered in 2021 only, this is for 1 year only, then as they are paid that through PAYE, 50% of it is then used to buy shares in the open market. And the other 50% is obviously to provide them with some income because their salaries have been materially reduced. Moving on to Gordon's question around the current status of the in-house ABAs. I showed you a slide of the material ones. There are other cases in progress. Blue Sky has obviously completed successfully with a 300% return in 2020. We have marked up the recovery from the 30 million we originally had in our slides, Gordon, to what you're seeing today. I think it unlikely that we would have a realisation on either of the two major cases. We have a couple of small ones again ongoing that we would have a realisation in 21, but we're expecting both of those to be in 2022 at the earliest. Moving on to Abby, what would you say differentiates you from the competition in the market? I think the main differentiator is our commercial focus, and that we are very, very, very focused on everything that we do. So nothing, as you can see from the IT services acquisition, which is a very small one, every single part of the business is looked at, and we decide what is the most commercially viable way of doing what we want to do. So I think that's what differentiates us. Robert, what would you say to that?
Yeah, I think the business has benefited from Nikki being in the business for a few years, and there's a monthly heartbeat which I don't see with other law firms, and especially ones that we're looking at. So every month we look at key metrics and we drive the key metrics into the business. So utilisation, realisation, a proper review of the WIP, a proper review of debtors. So you know, it's a very, as all businesses should be, it's very cash focused, and there is a monthly heartbeat. During the pandemic, what we've moved to as well around utilisation is looking at it weekly as well. So, you know, we're dynamic, we change with the environment, we're very focused on some of the key measures in the business, and we have an appreciation from the business of what those key measures are.
Mm-hmm. So the next question is Lionfish buying the claims or just funding the claims and thus not fully in control of the case settlement? That's correct. We're not buying the claim. We are funding the claim through investment, and therefore we're not in control of the case settlement. What we do to have an influence over the case settlement is through our pricing. So to make it as commercially viable and much cheaper for the client to settle and return money to us as early as possible. What we tend to find with clients is that they start the litigation with ideas that they're going to be paid out huge amounts of money, and then there's a general realization that comes during the case, and that realization leads to a better understanding of what the award may look like. And once they realize that, then they often want to ensure that they're giving as little of it back to the funder as possible. And that we find a much more successful way of influencing the case. But that is one of the reasons why we don't do elephant cases in Lionfish, because we're not the lawyer on record. The next question from Manuel is, in RBG law firm, can you provide some colour on the organic growth in teams during 2020? Given your high use of contractors, is the team essentially the same? Do you still have spare capacity to grow in 21? So yes, we or a partner-led business. So what we've done in expanding in 2020 into 21 was we brought on a new partner into the employment department to grow that business, and we've seen her bring in some resourcing underneath. We have brought on a new partner in competition law. We have a new partner coming on in restructuring, and we have a new partner coming on in real estate who is bringing a substantial client with them. And in those, what we do is we bring in the partner, and then we look at what capacity we need underneath that, and where we want it to be contractual, where it's suitable to be a contractor, or where it needs to be a team. We still do have capacity. I love looking at the capacity of the business. And if we were to utilize every single resource currently on payroll within RBL, our capacity for that business is 25 million today. And as you saw, it did just over 20 million within the numbers for last year. So there is still capacity. And obviously that is assuming that everybody is working full hours and recovering full hours. In Lionfish, is it seeking to reach an early settlement influence? Do we have? I think I've answered that question, which is, I think the only other thing to say is that there is an awful lot of work that goes into the Lionfish investments, and they're very, very well structured in the funding agreement. So the client, because we are funding the client and their advisor is their law firm, we do put a lot of conditions around that investment that they have to meet. So Bob then asks, what do you see as the 2 to 3 main risks to achieving your ambitions, and what are you doing to mitigate these? The biggest risk in our business, and I'm not sure if you would call it a risk or an opportunity, is the fact that we have in our sector some unrealistic expectations around valuations on M&A. And that has been frustrating, and why you have not seen us deliver an M&A, more M&A during the period that we've been a public company. We're working really, really hard to try to do those deals that are in a way that are fair to you as shareholders and maintaining the returns that we expect to provide to you, as well as doing right by those that we're buying the companies from. I think I can say, because it's public domain information, that the recent acquisition by K3, the corporate finance business of Quantuma, which was an insolvency practice, we were at an advanced stage with them, and we lost out to the higher bid. And this is for us very frustrating, and has happened to us a couple of times. Robert, is there anything you would add to that question?
Yeah, I think the current environment is very difficult, but I think our strategy to diversify the income streams is part of that work that we're doing in order to mitigate the risks. So yeah, we have a strong contentious business, but what we've built in with Convex is that we've got a deal-driven business or an M&A business that could counterbalance the contentious side to the business. And then again, with Lionfish, we're bringing on another revenue stream or potential that will mitigate having all our eggs in one single basket. So I think the part of it is, in order to manage the current environment, is that we've delivered, or we're investing in businesses that give us multiple opportunities to drive revenue and profit. The other key thing is that we're people businesses. We've been very successful, and we are very successful, that people stay with our business and drive into the business, and we work very hard to ensure that they have the best environment in order to be successful. So I think there's a couple of bits.
Thanks, Robert. And Dee asks, can I just confirm that potential returns from the litigation investments is over 120 million? The scale seems mind-blowingly large compared to our current market capitalization. I couldn't agree more. Yes, it is. That calculation is correct. And as Robert has mentioned earlier, that is really the hardest part of valuing us. The market, as you can see from the share price that we have, largely discounts these and doesn't take them into consideration. It is very difficult, we understand that, for the market to give us value for this, because they are very unpredictable about when they will fall. But with an 85% success rate, one should apply that to our potential returns and say that you will at least deliver 70–80% of that. And whilst that would, and that's just very difficult for the market to accept, but that is indeed our strategy. And I think really important, when you look at those elephantine cases that deliver the majority of that, in being the client on the record, one of the unique situations that we now bring to our clients is that we have both the legal team with the legal strategy and myself and my team who bring the commercial strategy around that litigation. Because often when you are attacking other huge companies, which we are in both of those cases, we're up against other public companies. And therefore, I have an understanding of how that public company will operate, how it will view the litigation, how it will provision. And therefore, I have contribution. I regularly sit with the client on one of those cases in discussing the legal strategy. And I think that differentiates us. So we are, confident that we will get a result. Obviously, at the end of the day, it's the award and the scale of the award that's very difficult to predict. Moving on, Alan asks, the corporate side within the legal services had a much better year last year, with around 4.5 million sales being doubled from the previous year. Is it a spike or an improving trend? There is no doubt that you do get a little bit of lumpiness in these businesses. We had that substantial transaction for Simon Cowell last year. We have a smaller repeat transaction for that client. We have some other transactions that are coming through. We would expect it to be steady. That department has tended to do around 3.5 to 4.5 million, depending on what transactions it's seeing. I wouldn't see that materially changing until we actually bring on an expansion to that team, which we would like to do. In one of the questions, I'm just reading down some of the questions. Robert, litigation funding is capital intensive. Do you have plans to increase your available capital? It's asked by David.
Yeah, it is.
I don't think it's that, David. It's David B.
No, and I think our model of funding from the balance sheet is that, look, we make selective investments. We're not about just building a massive pool or set of investments possible. So yes, it is capital intensive, but we use it selectively. But we've got a model that generates cash from the other sides of the business. Nikki mentioned part of the reason for the M&A activity with Convex is it was cash generative. So what we're trying to do is marry the resource across the business. So we have two cash generative businesses that enable us to distribute back to shareholders, but also invest in these capital investments through Lionfish and partly through RBL. And then there's another part to our business within Lionfish and RBL that if we want to, we can share that capital intensity with bringing in some partners that will invest into that capital as well, or into that investment. So yes, it is, but we have ways of managing that capital investment, and just to say that it is selective investments that we believe that will be the most profitable as well. It's a part to our business. It's not all of our business.
Thanks, Robert. David R. this time. I think, hang on, I'm getting confused as to which questions I'm. Okay, no, David B. This is again, where equity is given as remuneration, are there any lock-ins in place? Just on this point, because I have seen it talked about in the chat rooms, it is important to recognise when equity is provided as consideration under an M&A, under an acquisition, or where equity is provided under an option, there is a lock-in that is put in place to ensure that that share is not disposed of. If for under M&A and acquisition, it tends to be a 2-year hard lock-in and a 1-year soft. But where we do not use lock-ins, where lock-ins are not appropriate, is where the employee has earned the bonus, because with all of our bonus schemes, like the Convex commission scheme, but all of the company's bonus schemes provide that 50% of the net bonus is used to buy shares in the open market, because obviously tax is paid anyway on any option. So we felt this was the most tax efficient way of providing shares to staff. And those are not subject to lock-ins because they've bought them effectively with money they have earned. And therefore there is no it's not appropriate for there to be a lock-in. And then a question for Robert. What is the annual cost of running Lionfish?
Yeah, Lionfish is a very light model. So we have 2 full-time employees and a couple of contractors. And the total cost, the maximum cost of running it for a full 12-month period would be circa 500k, depending on success. So that's Lionfish. Can I pick up, Nikki? Alan C talked about the huge elephant cases, and would the other side be able to pay if they
Yes, I was about to ask that one. Yes.
Yes. So we don't take on these cases because they're interesting and they stimulate the law. We take on the cases because the other side definitely can pay if it loses. So there's a very commercial part to what we do in our litigation investments. Part of the commercial due diligence we do is there's no point doing the case if they can't pay when we beat them. So that is a huge part of what we do. We do a huge amount around the legal merits and the potential success of it. But there's equally a huge amount of work done on the commercial side of, if these people lose, do they have a balance sheet and cash availability in order to pay?
Yes, and I would go further to say that because as I've mentioned, sometimes the defendants are public companies, we're able to see what they're provisioning. We're able to see more because they have to be transparent. So we do an awful lot of work around due diligence. We're not able, I'm sorry, Atif, to disclose the multinational, the Shango case. All of our cases must remain confidential to the clients. So we're only able to do that at the end of the day when it's been settled or won. And that again assumes these weren't done under privileged confidential provisions. I think that has exhausted a lot of the. I don't think there's anything, some duplication on the questions. I don't think there's any material questions that I've missed.
No, I think you've addressed most of those questions that have come in there. As you say, there are a couple of duplicate, I guess, topics and themes. And of course, any questions that we haven't, we'll make present to you after the meeting, as ended anyway. Nicola, perhaps I could, I know investor feedback is particularly important, and I will direct investors to provide that. But perhaps ahead of that, I could ask you just for a few closing comments.
Yes, please. Investor comment is hugely important. We do read everything that's sent to us, and we do keep up with what is written about in the public domain. Communication is the key to running all businesses. And if you have questions and if you are wondering about things, you can always email our info lines or ourselves. They're all found on our website, and ask those questions directly, because we're on a public company. It's designed to be transparent, and we want everybody to understand what we're trying to do. And many thanks for taking the time out today to be on yet another screen.
That's brilliant. Thank you very much indeed to both to Nicola and to Robert for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, then the feedback page will just automatically appear. If you access this via the link sent you by email, you'll simply be asked to log in to submit your feedback. On behalf of the management team of RBG Holdings and Investor Meet Company, would like to thank you very much indeed for attending today's presentation. That now concludes today's session. Good morning to you all.